Welcome to the Smarter Money Life podcast hosted by Andy Mattingly. Frequent guest on local TV news, regular segment on Indy Now TV, and a leader here at Forum Credit Union. Forum's mission is to help members lead their financial dreams, and in today's podcast, we're going to cover a topic that will help you improve your financial life. Have you ever wondered what it takes to be a good borrowing prospect? Wouldn't you like for every lender to be competing for your business and really want it? Hi, I'm Andy Mattingly, and in today's Smarter Money Life podcast, we're going to talk about what it takes to be a great borrower. And with me today is someone who can really answer these questions because she's helping our members get loans all the time. It's Nicole Royle, our Assistant Vice President of Consumer Lending. So if you want to know what it takes to get a loan, Nicole is the person. So I'm just going to jump right in. What are the reasons that people don't get approved for a loan? Because I think that's a good place to start. They don't really understand sometimes why they don't get approved.
I mean, the big things that we look at are the big reasons that people get denied are because of high TDR, high RDR, or high DTI. So to break that down for you, TDR is just your total debt ratio. So how much debt are you carrying? RDR is your revolving debt ratio, that sort of credit card, line of credit access. And then DTI is your debt to income. On the other side, people don't qualify for loans because they have too limited credit. So they don't have enough established history in their background to base a decision off of.
So if I'm making $50,000 and I already have $25,000 in debt besides my car, that's probably not a good thing, right?
Right. That's a 50% debt to income ratio. That's a little too high.
Yes. So, you talked to another thing that you talked about is not having very much credit. What do you see with people that don't really have any credit? Is there anything that shows up on their credit at all that maybe they didn't think about should be on there?
I think a lot of people think that if I go out and I get a credit card, that's enough. I've been using that credit card for a year, that'll be enough for me. But really, revolving debt history isn't a good quality credit portfolio to have. You really want to have some sort of installment history. So an unsecured loan, an auto loan, something that shows that you can be given a minimum monthly payment and make it on time.
So we've talked about why people don't get approved. What are some of the really important characteristics of a strong borrowing prospect?
It's that dynamic credit history. So having a credit card, having revolving history, having installment loan history, if possible, having a mortgage. So if you want a really strong credit portfolio, it needs to be dynamic.
Oh, that's a really good word, dynamic. So one of the things that, I hear from people, and I know you do too, is that if they're struggling to get approved, what's the first thing that they should do? Like, what's the first thing you tell someone who says, you're not being approved? And we'll go with two scenarios. The first one is they're not getting approved because they really don't have any credit history at all.
Yeah. So they need to come to us and they need to get a credit builder loan. So they'll get a loan. They'll actually make minimum payments. So we have a lot of people that come to us for a credit builder credit card. They get it, but they never use it. So we want you to use it, make monthly payments, and show that you can make payments on time.
Yeah, that's a very good point because I think a lot of people get a credit card and they never use it. So it doesn't really show that you're making any payments. That's a very good point.
Or they use it and pay it off immediately. So you want that credit to show up. You want that debt to show so that you can make a payment on it. Yep.
Sure.
Yep.
That makes sense. Now let's take the other scenario. Someone who is in, they have a lot of debt, they have a lot of issues. Maybe it's the DTI score or the revolving debt ratio score. What are things that you would suggest to them that they need to do?
I mean, really, they need to sit down and take a look at their credit history and see, are they paying too high a payment on their auto loan? Can they refinance it, get a lower rate, and get a lower payment to help with that DTI? Are they carrying too much revolving debt and they're only making their minimum payments? Can they take that and can they consolidate that onto a more manageable payment? But they really need to look at what their situation is and see what options are out there.
Yeah, I think a lot of people don't think about the fact that, 2 years ago you bought this car loan and maybe, you were fine with the payment then, but now you've added some other debt and they don't think about refinancing the car loan. And, you may not get a better rate, but if you can change the term a little bit to get a little bit better payment, it can help you all around.
Well, and I think a lot of people think it costs money to refinance an auto loan. It's not like refinancing a mortgage. You can refinance an auto, change your term, change your rate, and there isn't a cost to it.
Important disclaimer, though, you do have to do a little bit of work with the BMV, but don't be afraid of that. It's not that bad, and it would be worth it to get the payments.
We'll walk you through
I
it.
do want to make sure that we are saying there might be a little pain. There might not be a cost, but
Right.
there is a little pain there. So what are other things do you think that people should do to kind of improve their borrowing profile?
I think that getting a credit builder credit card is a great way to either rebuild your credit if you've made some, bad decisions, or if you don't have any and you are trying to build a stronger portfolio, get a secured credit card even. Take it out, again, use it and make payments on it.
And just explain us how someone would, what's the way to get a secured credit card so that people really understand that?
Yep. So you front the money up front. So let's just say for easy math, we did a $500 secured card. You would actually give us $525. We would hold that money in a savings account and we would give you back a $500 credit card. So we hold 125% of the card itself. So then that savings is there and you make payments on it. You use it like a normal credit card. It doesn't report differently to the bureau. It doesn't have a negative effect on you to have a secured card. But those positive credit marks are so good for your credit history.
Yeah, that makes a lot of sense. So the other thing that some people will talk about, or we will tell people, is that a cosigner or a guarantor to improve your chances. So can you kind of walk through that? Like, what's the difference between a cosigner and a guarantor? And then what makes a good cosigner or what makes a good guarantor?
Yeah, so we run into this a lot. And a cosigner or a guarantor are good options if you are needing a stronger income for your application. So if you're working part-time or you're brand new on your job or your income just doesn't support the loan you're asking for, adding a co-borrower like a spouse then will boost that income, or adding a cosigner like a parent will help. What a cosigner and a co-borrower won't help you with is derogatory credit. So if you come in with negative credit history, putting a cosigner on your loan isn't going to help you qualify.
Right. And if your cosigner or guarantor has derogatory credit, that's kind of a problem
They are
too.
not going to help either.
So now, another thing you talked a little bit about it right there is with income. How can people get around the issue if they don't necessarily have all verifiable income? Because we run into that sometimes, that people don't have verifiable income because they're paid in cash or things like that. So what are some options, or what are some advice do you have for people in that situation?
Yeah, I mean, that's something that we see frequently, especially for self-employed people. They only claim a certain percentage of their income, which is great from a tax perspective. But when you're trying to qualify for an unsecured loan for $50,000, not claiming all that income can hurt you.
And I think that's one thing that when you have a cosigner or a guarantor where you need some more income, that can really help you in that way. So that's a reason to do it. And it's not negative on your credit history.
Right.
Or will people, because it's more about, are you making sure you're making those payments more than anything?
And that's often where that co-borrowing spouse comes in and helps offset that debt that they're carrying.
One of the things that we talk about, you've talked a lot about with building your credit profile is, paying things down or debt to income ratio, some of those things. What I want to dive into a little bit, and I'm probably going to throw you for a little bit of a loop with this because you talk about loans, but how much do you believe that having solid money management skills pay into that? Like, do you advise people who, when you look at what they're paying things for and saying, maybe you should think more about that?
Yeah, I mean, I think that's a thing that people can get easily caught up with. Just because you have the power to borrow doesn't mean you always should. Right? So even good income borrowers, we see this, they're carrying a lot of debt.
And one of the biggest ways that people get into it is the buy now, pay later. It's so easy when you go to the furniture store or different places like that to end up with that kind of additional debt expense that gets reported, and all of a sudden you have a lot of payments out there and then you can't really qualify for anything.
Right. And maybe you forget that you've done it twice already in the month previous. And so then you say, I'm going to do it again. And now you have all of these minimum payments that really start to add up.
And I think that's the other thing about when we're trying to help people build a credit profile is we also want them to take a little bit of look back into their own personal way of how they manage their money and what they do. And, you talked a lot about this with the credit card. And, we talked about this with Chris Ferguson before about building your credit score. some people come in and they only want a limited limit. You're like, well, I only want a $2,000 limit, and they may qualify for $6,000 or $7,000. Explain to people why it's important to get the higher limit, because maybe you're going to carry a balance of $2,000 on it, and you just want to, explain why that's so important.
Right. So I appreciate the people that say, hey, I don't want more than $2,000, because I understand maybe that's what they're willing to kind of work with. But what we really try to advise people on is what you just said. If you are borrowing a $2,000 credit card and you are going to instantly max it out, that maxed out credit card actually has a negative impact on your credit score. So if you're looking to spend $2,000, take the $5,000 offer and give yourself a little bit of a cushion.
Yeah, because that's one of the things that when they're building the credit scores, they look at how much of the credit that you qualify for that you're using. And if you're using every limit on your revolving charges, that's a negative, versus if you're only using like 20 or 30%, then that's a positive, because it says people are willing to give you more money. So that must mean you're doing a lot of things right in your life. So one of the other things that can help in a credit profile is, besides being approved, it can also help in pricing, correct?
Correct. So the higher the credit score, the better the pricing that you're going to receive. So yes, we loan to people above a 600, but that higher pricing on that loan is going to make that payment that much larger for you. And again, that much more difficult to manage.
Now, one of the things we've talked a little bit about this in the past is that if you're a young person starting out, there is starting to be some ideas of that if you rent from a larger apartment complex, they may report that can help you show that you have payments, and people are starting to get into those things. But what would you tell someone who says, yeah, I pay a lot of things late and it doesn't matter? Do you think that's a smart move?
No. I mean, that credit history is there. You're working for it. You want it to be positive, because right now, maybe you're thinking, well, I don't need to buy a car, but that could change. And in 5 years, the difference of an interest rate can be really impactful.
Yeah. And I think that's a thing that people don't realize, is that paying late can stay around for a long time, because we're going to look back, most credit bureaus and putting the score together are going to look back how many times you've been 30 days or more late in the last 2 years, 3 years, something like that. What do you find is the thing that people have the most difficult time in improving their credit profile with? Is it building credit, or is it having the bad credit piece?
I know. So I always relate this to like a weight loss plan. It's really hard to come back from damaging your credit. So if you have made those 30 or 60 or 90-day lates, if you've charged something off, if you've repoed something, those things are hard to make up for. So it's just easier to take the credit you can manage and pay it on time.
Yeah. So, one of the things that we hope that you've gotten from this podcast today is that wherever you are with your credit profile, it's just important to keep moving it forward. And, Nicole's team, anywhere that you go for advice is going to give you the same type of advice. Building your credit profile, being that borrower that everyone wants to give, loans to is great. But hopefully you listen to just what Nicole just said there. You don't have to take everything that's offered to you and then overextend yourself, because in the end, that's going to pull your credit profile down. This has been another episode of the Smarter Money Life podcast, powered by Forum Credit Union. Please leave your thoughts in the comments, and be sure to look for our next episode wherever you get your podcast. Remember, now is a great time to make a difference in your financial life. Until next time.